of accounting standards, grasp the objectives and benefits and limitations of accounting standards, learn the standard setting process, familiarize with the status of accounting standards in India, recognize the international accounting standard authorities, appreciate the emergence of international financial reporting standards as global standards, differentiate between convergence versus adoption, know the process of convergence of IFRS in India, understand the concept of INDs, understand the objectives and concepts of carve-outs/ins. Copyright the Institute of Chartered Accountants of India 1.2 Accounting Introduction, Objectives and Benefits of Accounting Standards. Accounting Standards Setting Process. List of Accounting Standards. Convergence to IFRS in India. International Financial Reporting Standards, IFRS, need for convergence to global standards. Concept of INDs. Carve-outs and carve-ins. Roadmap for INDs implementation. 1. Introduction. Generally Accepted Accounting Principles. Generally Accepted Accounting Principles, GAAP, refer to a common set of accepted accounting principles, standards, and procedures that business reporting entity must follow when it prepares and presents its financial statements. GAAP is a combination of authoritative standards, set by policy boards, and the commonly accepted ways of recording and reporting accounting information. At international level, such authoritative standards are known as International Financial Reporting Standards, IFRS. At many places and in India we have authoritative standards named as Accounting Standards, AS, and Indian Accounting Standard, INDs. Copyright the Institute of Chartered Accountants of India 1.3 Introduction to Accounting Standards. Accounting Standards, AS, are written policy documents issued by the government with the support of other regulatory bodies. Example: Ministry of Corporate Affairs, MCA, issuing accounting standards for corporates in consultation with National Financial Reporting Authority, NFRA, covering the following aspects of accounting transaction or events in the financial statements: recognition, measurement, presentation, and disclosure. The ostensible purpose of the standard-setting bodies is to promote the dissemination of timely and useful financial information to investors and certain other stakeholders, having an interest in the company's economic performance. Accounting standards reduce the accounting alternatives in the preparation of financial statements within the bounds of rationality, thereby ensuring comparability of financial statements of different enterprises. Accounting standards deal with the following aspects: I. Recognition of events and transactions in the financial statements. 2. Measurement of these transactions and events. 3. Presentation of these transactions and events in the financial statements in a manner that is meaningful and understandable to the reader, and 4. The disclosures relating to these transactions and events to enable the public at large and the stakeholders and the potential investors in particular, to get an insight into what these financial statements are trying to reflect and thereby facilitating them to take prudent and informed business decisions. Accounting standards deal with aspects of accounting events: recognition of events and transactions, measurement of transactions and events, presentation of transactions and events. Copyright the Institute of Chartered Accountants of India. Disclosure requirements 1.4 Accounting. The following are the benefits of accounting standards. I. Standardization of alternative accounting treatments. Accounting standards reduce or eliminate, to a reasonable extent, any confusing variations in the accounting treatment and presentation of economic events while preparing financial statements. The standard policies are intended to reflect a consensus on accounting policies to be used in different identified areas, e.g. inventory valuation, capitalization of costs, depreciation and amortization, etc. Since it is not possible to prescribe a single set of policies for any specific accounting area that would be appropriate for all enterprises, it is not enough to comply with the standards and state that they have been followed. In other words, one must also disclose the accounting policies used in preparation of financial statements. Refer as 1. Disclosure of accounting policies given in accounting pronouncements. For example, an enterprise should disclose which of the permitted cost formula, FIFO, weighted average, etc., has actually been used for ascertaining inventory costs. 2. Requirements for additional disclosures. there are certain areas where information is not statutorily required to be disclosed. However, accounting standards may call for appropriate disclosures of accounting policies followed and other required information in the financial statements which would be helpful for readers to understand the accounting treatment done for various items in those financial statements. 3. Comparability of financial statements. In addition to improving credibility of accounting data, standardization of accounting procedures improves comparability of financial statements, both intra-enterprise and inter-enterprise. Such comparisons are very effective and most widely used tools for assessment of enterprises' financial health and performance by users of financial statements for taking economic decisions, example whether or not to invest, whether or not to lend and so on. The intra-enterprise comparison involves comparison of financial statements of same enterprise over a number of years. The intra-enterprise comparison is possible if the enterprise uses same accounting policies every year in drawing up its financial statements. Copyright the Institute of Chartered Accountants of India Introduction to Accounting Standards 1.5. The inter-enterprise comparison involves comparison of financial statements of different enterprises for same accounting period. This is possible only when comparable enterprises use similar accounting policies in preparation of respective financial statements, or in case the policies are slightly different, the same are disclosed in the financial statements. The disclosure of accounting policies allows a user to make appropriate adjustments while comparing the financial statements of comparable enterprises. Standardization of alternative accounting treatments. Benefits of accounting standards. Comparability of financial statements. Requirements for additional disclosures. Since accounting standards are principle-based, application of accounting standards becomes judgmental in case of complex business transactions. Accounting standards have to be read in line with the legal requirements, i.e., in case of any conflict, statute would prevail over accounting standards. Another advantage of standardization is reduction of scope for creative accounting. The creative accounting refers to twisting of accounting policies to produce financial statements favorable to a particular interest group. For example, it is possible to overstate profits and assets by capitalizing revenue expenditure or to understate them by writing off a capital expenditure against revenue of current accounting period. Such practices can be curbed only by framing policies for capitalization, particularly for the borderline cases where it is possible to have divergent views. The accounting standards provide adequate guidance in this regard. Copyright the Institute of Chartered Accountants of India 1.6 Accounting 2. Standard setting process. The Institute of Chartered Accountants of India, ICAI, being a premier accounting body in the country, took upon itself the leadership role by constituting the Accounting Standards Board, ASB, in 1977. The ICAI has taken significant initiatives for the issuance of accounting standards to ensure that the standard setting process is fully consultative and transparent. The ASB considered the International Accounting Standards, IASs, / International Financial Reporting Standards, IFRSs, while framing accounting standards, AS, in India and tried to integrate them, in the light of the applicable laws, customs, usages, and business environment in the country. The composition of ASB includes representatives of industries, associations of industries, namely, ASSOCHAM, CII, FICCI, regulators, academicians, government departments, etc. Although ASB is a body constituted by the Council of the ICAI, it, ASB, is independent in the formulation of accounting standards. NFRA recommend these standards to the MCA. MCA has to spell out the accounting standards applicable for companies in India. The standard setting procedure of ASB can be briefly outlined as follows: diamond suit identification of broad areas by ASB for formulation of AS. Diamond suit constitution of study groups by ASB to consider specific projects and to prepare preliminary drafts of the proposed accounting standards. The draft normally includes objective and scope of the standard, definitions of the terms used in the standard, recognition and measurement principles wherever applicable, and presentation and disclosure requirements. Diamond suit consideration of the preliminary draft prepared by the study group of ASB and revision, if any, of the draft on the basis of deliberations. Diamond suit circulation of draft of accounting standard, after revision by ASB, to the council members of the ICAI and specified outside bodies such as MCA, Securities and Exchange Board of India, SEBI, Controller and Auditor General of India, CNAG, Central Board of Direct Taxes, CBDT, Standing Conference of Public Enterprises, Scope, etc. for comments. Diamond suit meeting with the representatives of the specified outside bodies to ascertain their views on the draft of the proposed accounting standard. Diamond suit finalization of the exposure draft of the proposed accounting standard and its issuance inviting public comments. Diamond suit consideration of comments received on the exposure draft and finalization. Copyright the Institute of Chartered Accountants of India Introduction to Accounting Standards 1.7 of the draft accounting standard by the ASB for submission to the Council of the ICAI for its consideration and approval for issuance. Diamond suit consideration of the final draft of the proposed standard by the Council of the ICAI and if found necessary, modification of the draft in consultation with the ASB is done. Diamond suit the accounting standard on the relevant subject, for non-corporate entities, is then issued by the ICAI. For corporate entities the accounting standards are issued by the Ministry of Corporate Affairs in consultation with the NFRA. Standard, setting process identification of area constitution of study group preparation of draft and its circulation ascertainment of views of different bodies on draft finalization of exposure draft, ED. Comments received on exposure draft, ED, modification of the draft issue of as earlier, ASB used to issue accounting standard interpretations, ASIS, which address questions that arise in course of application of standard. These were, therefore, issued after issuance of the relevant standard. Authority of the ASIS was same as that of the as to which it relates. However, after notification of accounting standards by the central government for the companies, where the consensus portion of ACI was merged as explanation to copyright the Institute of Chartered Accountants of India 1.8 accounting the relevant paragraph of the accounting standard, the Council of ICAI also decided to merge the consensus portion of ACI as explanation to the relevant paragraph of the as issued by them. This initiative was taken by the Council of the ICAI to harmonize both the set of standards, i.e., as issued by the ICAI for non-corporates and as notified by the MCA for corporates. It may be noted that as per Section 133 of the Companies Act, 2013, the central government may prescribe the standards of accounting or any addendum thereto, as recommended by the ICAI, constituted under Section 3 of the Chartered Accountants Act, 1949, in consultation with and after examination of the recommendations made by NFRA. 3. How many accounting standards? The Institute of Chartered Accountants of India has, so far, issued 29 accounting standards. However, as 6 on depreciation accounting has been withdrawn on revision of as 10 property, plant and equipment and as 8 on accounting for research and development has been withdrawn consequent to the issuance of as 26 on intangible assets. Thus effectively, there are 27 accounting standards at present. The accounting standards issued by the Accounting Standards Board establish standards which have to be complied by the business entities so that the financial statements are prepared in accordance with GAAP. In recent times there are various improvements/developments in the global accounting standards which have taken place. In India, INDs have become mandatory for certain class of companies as per the MCA roadmap. As being the guidelines to prepare financial statements, have to keep pace with these changes in global accounting scenarios. Number of fundamental changes have been made in these as so as to be globally aligned as far as possible. MCA VID notification date March 30, 2016 announced companies, accounting standards, amendment rules, 2016. Various AS-IE as 2, as 4, as 10, as 13, as 14, as 21, as 29 were revised vide this notification to make them in line with corresponding INDs to the extent possible. Earlier as 10 was on accounting for fixed assets. Copyright the Institute of Chartered Accountants of India 1.9 Introduction to Accounting Standards. The following is the list of accounting standards with their respective date of applicability, as no. As title: date of applicability 1. Disclosure of accounting policies January 4, 1993. 2. Valuation of inventories, revised, January 4, 1999. 3. Cash flow statement January 4, 2001. 4. Contingencies and events occurring after the balance sheet date, revised, January 4, 1998. 5. Net profit or loss for the period, prior period items and changes in accounting policies January 4, 1996. 7. Construction contracts January 4, 2002. 9. Revenue recognition January 4, 1993. 10. Property, plant, and equipment, revised, January 4, 2016. 11. The effects of changes in foreign exchange rates, revised, January 4, 2004. 12. Accounting for government grants January 4, 1994. 13. Accounting for investments, revised, January 4, 1995. 14. Accounting for amalgamations, revised, January 4, 1995. 15. Employee benefits January 4, 2006. 16. Borrowing costs January 4, 2017. Segment reporting January 4, 2001. 18. Related party disclosures January 4, 2001. 19. Leases January 4, 2001. 20. Earnings per share January 4, 2001. 21. Consolidated financial statements, revised, January 4, 2001. 22. Accounting for taxes on income January 4, 2006. 23. Accounting for investments in consolidated financial statements. Copyright the Institute of Chartered Accountants of India Associates in January 4, 2002. 1.10. Accounting 24. Discontinuing operations January 4, 2004. 25. Interim financial reporting January 4, 2002. 26. Intangible assets January 4, 2003. 27. Financial reporting of interests in joint ventures January 4, 2002. 28. Impairment of assets January 4, 2008. 29. Provisions, contingent liabilities, and contingent assets, revised, January 4, 2004. Note, as 1, as 2, revised, as 3, as 10, revised, as 11, revised, as 12, as 13, revised, as 16 are covered in the syllabus of this paper at intermediate level. For status of accounting standards, it has already been mentioned that the AS are developed by the ASB of the ICAI. The institute, not being a legislative body, can enforce compliance with its standards only by its members. Also, the standards cannot override laws and local regulations. The AS are nevertheless made mandatory from the dates specified in respective standards and are generally applicable to all enterprises, subject to certain exceptions. The implication of mandatory status of an AS depends on whether the statute governing the enterprise concerned requires compliance with the AS. The Companies Act had earlier notified 28 AS and mandated the corporate entities to comply with the provisions stated therein. However, in 2016 the MCA withdrew as 6. Hence there are now only 27 notified AS as per the Companies, Accounting Standards, Rules, 2006, as amended in 2016. 5. Need for convergence. Global standards towards the last decade has witnessed a sea change in the global economic scenario. The emergence of transnational corporations in search of money, not only for fueling growth, but to sustain ongoing activities, has necessitated raising of capital from all parts of the world, cutting across frontiers. Copyright the Institute of Chartered Accountants of India. Introduction to Accounting Standards 1.11. Each country has its own set of rules and regulations for accounting and financial reporting. Therefore, when an enterprise decides to raise capital from the markets other than the country in which it is located, the rules and regulations of that other country will apply, and this in turn will require that the enterprise is in a position to understand the differences between the rules governing financial reporting in the foreign country as compared to its own country of origin. Therefore, translation and reinstatements are of utmost importance in a world that is rapidly globalizing in all ways. Further, the AS and principles need to be robust so that the larger society develops degree of confidence in the financial statements, which are put forward by organizations. International analysts and investors would like to compare financial statements based on similar AS, and this has led to the growing need for an internationally accepted set of AS for cross-border filings. The harmonization of financial reporting around the world will help to raise confidence of investors, generally, in the information they are using to make their decisions and assess their risks. Also, a strong need was felt by legislation to bring about uniformity, rationalization, comparability, transparency, and adaptability in financial statements. Having a multiplicity of types of AS around the world is against the public interest. If accounting for the same events and information produces different reported numbers, depending on the system of standards that are being used, then it is self-evident that accounting will be increasingly discredited in the eyes of those using the numbers. It creates confusion, encourages error, and may facilitate fraud. The cure for these ills is to have a single set of global standards, of the highest quality, set in the interest of public. Global standards facilitate cross-border flow of money, global listing in different stock markets and comparability of financial statements. The convergence of financial reporting and AS is a valuable process that contributes to the free flow of global investment and achieves substantial benefits for all capital market stakeholders. It improves the ability of investors to compare investments on a global basis and, thus, lower their risk of errors of judgment. It facilitates accounting and reporting for companies with global operations and eliminates some costly requirements like reinstatement of financial statements. It copyright the Institute of Chartered Accountants of India 1.12 Accounting has the potential to create a new standard of accountability and greater transparency provides value to all market participants including regulators. It reduces operational challenges for accounting firms and focuses their values and expertise around an increasingly unified set of standards. It creates an unprecedented opportunity for standard setters and other stakeholders to improve the reporting model. For the companies with joint listings in both domestic and foreign country, the convergence is very much significant. 6. International Board, IASB, accounting standard with a view of achieving the objective of setting global standards, the London-based group namely the International Accounting Standards Committee, IASC, responsible for developing international accounting standards, IAS, was established in June, 1973. It is presently known as International Accounting Standards Board, IASB. The IASC comprises the professional accountancy bodies of over 75 countries, including the ICAI. Primarily, the IASC was established, in the public interest, to formulate and publish IASs to be followed in the preparation and presentation of financial statements. IASs were issued to promote acceptance and observance of IASs worldwide. The members of IASC undertook a responsibility to support the standards developed by IASC and to propagate those standards in their respective countries. Between 1973 and 2001, the IASC released IASs. Between 1997 and 1999, the IASC restructured their organization, which resulted in formation of IASB. These changes came into effect on April 1, 2001. Subsequently, IASB issued statements about current and future standards. IASB publishes its standards in a series of pronouncements called International Financial Reporting Standards, IFRS. However, IASB has not rejected the standards issued by the IASC. Those pronouncements continue to be designated as International Accounting Standards, IAS. The standards issued by IASC till 3.1.03.2001 are known as IASs and the standards issued by IASB since January 4, 2001 are known as IFRSs. Copyright the Institute of Chartered Accountants of India Introduction to Accounting Standards 1.137. International Financial Reporting Standards, IFRS, as global standards IFRS issued by IASB, IAS issued by IASC and adopted by IASB, IFRS interpretations on IAS/IFRS issued by IFRS Interpretation Committee, interpretation on IAS issued by SIC. The term International Financial Reporting Standards, IFRS, comprises IFRS issued by IASB, IAS issued by IASC, interpretations issued by the Standard Interpretations Committee, SIC, and the IFRS Interpretations Committee of the IASB. IFRSs are considered as a principles-based set of standards. In fact, they establish broad rules rather than dictating specific treatments. Every major nation is moving toward adopting them to some extent. Large number of authorities permits public companies to use IFRS for stock exchange listing purposes, and in addition, banks, insurance companies, and stock exchanges may use them for their statutorily required reports. So, over the next few years, number of companies will adopt the international standards. This requirement will affect thousands of enterprises, including their subsidiaries, equity investors, and joint venture partners. The increased use of IFRS is not limited to public companies' listing requirements or statutory reporting. Many lenders and regulatory and government bodies are looking to IFRS to fulfill local financial reporting obligations related to financing or licensing. Copyright the Institute of Chartered Accountants of India 1.14 Accounting 8. Becoming IFRS compliant. Any country can become IFRS compliant either by adoption process or by convergence process. Adoption would mean that the country sets a specific timetable when specific entities would be required to use IFRS as issued by the IASB. Convergence means that the country will develop high-quality, compatible accounting standards and there would be alignment of the standards of different standard setters with a certain rate of compromise, by adopting the requirements of the standards either fully or partially. INDs are almost similar to IFRS but with few carve-outs so as to make them suitable for Indian environment. Convergence with IFRS will result in following benefits: improves investor confidence across the world with transparency and comparability, improves inter-unit/inter-firm/inter-industry comparison, group consolidation will be easy with same standard by all companies in group irrespective of their global location. Acceptability of financial statements by stock exchanges across the globe, which will facilitate listing of Indian companies to international stock exchanges. Cross-border flow of money. Listing of companies at global stock exchange helps investors in decision-making. Becoming IFRS compliant. Comparability of financial statements, low risk of error, greater transparency. Copyright the Institute of Chartered Accountants of India. Introduction to Accounting Standards 1.159. What are carve-outs/ins in INDs? The Government of India in consultation with the ICAI decided to converge and not to adopt IFRS issued by the IASB. The decision of convergence rather than adoption was taken after the detailed analysis of IFRS requirements and extensive discussion with various stakeholders. Accordingly, while formulating INDs, efforts have been made to keep these standards, as far as possible, in line with the corresponding IAS/IFRS, and departures have been made where considered absolutely essential. These changes have been made considering various factors, such as various terminology-related changes have been made to make it consistent with the terminology used in law, example statement of profit and loss in place of statement of comprehensive income and balance sheet in place of statement of financial position. Removal of options in accounting principles and practices in INDs vis-a-vis IFRS, have been made to maintain consistency and comparability of the financial statements to be prepared by following INDs. However, these changes will not result into carve-outs. Certain changes have been made considering the economic environment of the country, which is different as compared to the economic environment presumed to be in existence by IFRS. These differences are due to differences in economic conditions prevailing in India. These differences, which are in deviation to the accounting principles and practices stated in IFRS, are commonly known as carve-outs. Additional guidance given in INDs over and above what is given in IFRS, is termed as carve-in. Copyright the Institute of Chartered Accountants of India 1.16 Accounting formulation of IND as departures resulting into carve-outs not resulting into carve-outs deviation from the accounting principles stated in IFRS removal of options in accounting principles and practices in IND as vis-a-vis IFRS 10. Convergence to IFRS in India. In the scenario of globalization, India cannot isolate itself from the accounting developments taking place worldwide. In India, so far as the ICAI, NFRA and various regulators such as SEBI and Reserve Bank of India, RBI, are concerned, the aim is to comply with the IFRS to the extent possible with the objective to formulate sound financial reporting standards for the purpose of preparing globally accepted financial statements. The ICAI, being a member of the International Federation of Accountants, IFAC, considered the IFRS and tried to integrate them, to the extent possible, in the light of the laws, customs, practices, and business environment prevailing in India. Due to the recent stream of overseas acquisitions by Indian companies, there is need for adoption of high-quality standards to convince foreign enterprises about the financial standing as also the disclosure and governance standards of Indian acquirers. In India, the ICAI has worked towards convergence of global accounting standards by considering the application of IFRS in Indian corporate environment. Recognizing the growing need of full convergence of IND as with IFRS, ICAI constituted a task force to examine various issues involved. Full convergence involves adoption of IFRS in the same form as that issued by the IASB. Copyright the Institute of Chartered Accountants of India 1.17 Introduction to Accounting Standards for Convergence of IND as with IFRS. The ASB, in consultation with the MCA, decided that there will be two separate sets of accounting standards, viz. IND as converged with the IFRS, standards which are being converged by eliminating the differences of the IND as vis-a-vis IFRS, and 2. Existing notified as ICAI convergence to IFRS, not adoption application of IFRS in India considering legal and other conditions prevailing in India deviation from corresponding IFRS, if required decision to have two set of accounting standards Indian accounting standards, IND as, existing accounting standards, AS, 11. What are Indian standards, IND as? Accounting IND as are IFRS converged standards issued by the central government of India under the supervision and control of ASB of ICAI and in consultation with NFRA. NFRA recommends these standards to the MCA. MCA has to spell out the accounting standards applicable for companies in India. IND as are named and numbered in the same way as the corresponding IAS. However, for IND as corresponding to IFRS, one need to add 100 to the IFRS number, e.g. for IFRS 1 corresponding IND as number is 101. Indian Accounting Standards Globalization and Liberalization Transparency of Financial Statements. Copyright the Institute of Chartered Accountants of India Comparability of Financial Statements Enhanced Disclosure Requirements 1.18 Accounting 12. History of IFRS Converged Accounting Standards, IND as Indian first step towards IFRS. The ICAI being the accounting standards setting body in India, way back in 2006, initiated the process of moving towards the IFRS issued by the IASB with a view to enhance acceptability and transparency of the financial information communicated by the Indian corporates through their financial statements. This move towards IFRS was subsequently accepted by the Government of India. Government of India, commitment to IFRS converged IND as per the original roadmap for implementation of IFRS converged IND as issued by the Government of India. Initially IND as were expected to be implemented from the year 2011. However, keeping in view the fact that certain issues including tax issues were still to be addressed, the Ministry of Corporate Affairs decided to postpone the date of implementation of IND as. In 2014, the then Honourable Union Finance Minister of India, late Shri Arun Jaitley, in his budget speech in July 2014 stated that, there is an urgent need to converge the current Indian accounting standards with the International Financial Reporting Standards, IFRS. I propose for adoption of the new Indian Accounting Standards, INDs, by the Indian companies from the financial year 2015 to 16 voluntarily and from the financial year 2016 to 17 on a mandatory basis. Based on the international consensus, the regulators will separately notify the date of implementation of INDs for the banks, insurance companies, etc. Standards for the computation of tax would be notified separately. Pursuant to the above announcement, various steps were taken to facilitate the implementation of IFRS Converged Indian Accounting Standards, INDs. Moving in this direction, the Ministry of Corporate Affairs, MCA, has issued the Companies, Indian Accounting Standards, Rules, 2015 VIDI notification dated February 16, 2015, including the revised roadmap of implementation of INDs for companies other than banking companies, insurance companies, and NBFCs. As per the notification, INDs converged with IFRS shall be implemented on voluntary basis from April 1, 2015 and mandatorily from April 1, 2016. Further, the MCA on March 30, 2016, had also notified the roadmap for implementation of INDs for scheduled commercial banks, insurance companies, and NBFCs from April 1, 2018 onwards, and also amendments to INDs in line with the amendments made in IFRS/IAS VIDI Companies, Indian Accounting Standards, Amendment Rules, 2016. Copyright the Institute of Chartered Accountants of India 1.19 Introduction to Accounting Standards. However, ICAI VIDI press release dated June 28, 2017 had deferred the implementation of INDs for the insurance sector in India for a period of 2 years, whereby the effective date was deferred to FY 2020-21. Thereafter, VIDI circular dated January 21, 2020, ICAI has deferred implementation of INDs in the insurance sector till further notice. Additionally, the insurance companies are no longer required to submit pro forma INDs financial statements to ICAI on quarterly basis as was required earlier. The Reserve Bank of India VIDI its circular dated April 5, 2018 had deferred the implementation of INDs for scheduled commercial banks, SCBs, excluding regional rural banks, RRBs, by 1 year, i.e., to be made effective from April 1, 2019 onwards. However, VIDI circular dated March 22, 2019, the implementation of INDs for scheduled commercial banks, SCBs, has been further deferred until further notice by the Reserve Bank of India. One of the most significant steps in moving towards INDs taken by the ICAI was to provide a stable platform to the Indian entities for smoother and for effective implementation of INDs. It has been decided to converge early by notifying INDs corresponding to IFRS 9, Financial Instruments, effective from January 1, 2018, issued by the IASB. The ICAI continues with its march towards continuous convergence with IFRS standards at all times and closely monitors the amendments in IFRS standards with timely incorporation of those changes in INDs. The IASB issued IFRS 15 revenue from contracts with customers with effect from January 1, 2018 and IFRS 16 leases with effect from January 1, 2019. Consequently, to keep in pace with the global standards, ICAI formulated INDs 115 revenue from contracts with customers, which was notified by MCA in March 2018 effective for FY 2018-19 onwards, and INDs 116 leases, which was notified by MCA in March 2019 for FY 2019-20 onwards. 13 List of INDs. The following is the list of INDs vis-a-vis IFRS and as INDs IAS/IFRS. Title of INDs/IFRS 101 IFRS 1 First time adoption of Indian Accounting Standards 102 IFRS 2 Share-based payment. Copyright the Institute of Chartered Accountants of India as/GN, GN as/GN. Title, Guidance Note Accounting on for 1.20 Accounting IND as IAS/IFRS Title of IND as/IFRS 103 IFRS 3 Business Combinations 104 IFRS 4 Insurance Contracts 105 IFRS 5 Non-Current Assets Held for Sale and Discontinued Operations as 24 Discontinuing Operations 106 IFRS 6 Exploration for and Evaluation of Mineral Resources GN 15 Guidance Note on Accounting for Oil and Gas Producing Activities 107 IFRS 7 Financial Instruments, Disclosures, 108 IFRS 8 Operating Segments as 17 109 IFRS 9 Financial Instruments, 110 IFRS 10 Consolidated Financial Statements as 21 Consolidated Financial Statements 111 IFRS 11 Joint Arrangements as 27 Financial Reporting of Interests in Joint Ventures 112 IFRS 12 Disclosure of Interests in Other Entities, 113 IFRS 13 Fair Measurement, 114 IFRS 14 Regulatory Accounts Deferral GN Accounting for Rate-Regulated Activities 115 IFRS 15 Revenue Contracts Customers from with as 7 as 9 Construction Contract Revenue Recognition 116 IFRS 16 Leases as 19 Leases Value Copyright The Institute of Chartered Accountants of India as/GN as 14, as/GN Title Employee Share-Based Payments Accounting Amalgamations for Segment Reporting, Introduction to Accounting Standards IND as IAS/IFRS Title of IND as/IFRS 117 is under Formulat I on IFRS 17 Insurance Contracts, it will replace IFRS 4, 1 IAS 1 Presentation of Financial Statements as 1 Disclosure of Accounting Policies 2 IAS 2 Inventories as 2 Valuation Inventories 7 IAS 7 Statement Flows Cash as 3 Cash Flow Statements 8 IAS 8 Accounting Policies, Changes in Accounting Estimates and Errors as 5 Net Profit or Loss for the Period, Prior Period Items and Changes in Accounting Policies 10 IAS 10 Events after Reporting Period as 4 Contingencies and Events occurring after the Balance Sheet Date 12 IAS 12 Income Taxes as 22 Accounting for Taxes on Income 16 IAS 16 Property, Plant Equipment as 10 Property, Plant Equipment 19 IAS 19 Employee Benefits as 15 Employee Benefits 20 IAS 20 Accounting for Government Grants and Disclosure of Government Assistance as 12 Accounting for Government Grants 21 IAS 21 The Effects of Changes in Foreign Exchange Rates as 11 The Effects of Changes in Foreign Exchange Rates 23 IAS 23 Borrowing Costs as 16 Borrowing Costs 24 IAS 24 Related Disclosures as 18 Related Disclosures of the N Party Copyright The Institute of Chartered Accountants of India as/GN 1.21 as/GN Title of N Party 1.22 Accounting IND as IAS/IFRS Title of IND as/IFRS IAS 27 Separate Statements 28 IAS 28 Investment in Associates and Joint Ventures as 23-29 IAS 29 Financial Reporting in Hyperinflationary Economies, 32 IAS 32 Financial Instruments, Presentation, 33 IAS 33 Earnings per share as 20 Earnings per share 34 IAS 34 Interim Reporting as 25 Interim Reporting 36 IAS 36 Impairment of Assets as 28 Impairment of Assets 37 IAS 37 Provisions, Contingent Liabilities and Contingent Assets as 29 Provisions, Contingent Liabilities and Contingent Assets 38 IAS 38 Intangible Assets as 26 Intangible Assets 40 IAS 40 Investment Property as 13 Accounting Investments 41 IAS 41 Agriculture 27 Financial as/GN Title, Accounting for Investment in Associates in Consolidated Financial Statements Financial 14 Roadmap for Implementation of Indian Accounting Standards, IND as a snapshot for companies other than banks, NBFCs, and insurance companies Phase I, April 1, 2015 or thereafter, with comparatives voluntary basis for any company, other than banks, NBFCs, and insurance companies, and its holding, subsidiary, joint venture, JV, or associate company. Copyright The Institute of Chartered Accountants of India Introduction to Accounting Standards 1.23 April 1, 2016, Mandatory Basis, A. Companies listed/in process of listing on stock exchanges in India or outside India having net worth of INR 500 crore or more. B. Unlisted companies having net worth of INR 500 crore or more. C. Parent, subsidiary, associate, and JV of above. Phase 2, April 1, 2017, mandatory basis. A. All companies which are listed/or in process of listing on stock exchanges in India or outside India not covered in Phase I, other than companies listed on SME exchanges. B. Unlisted companies having net worth of INR 250 crore or more but less than INR 500 crore. C. Parent, subsidiary, associate, and JV of above. Special points to consider: companies listed on SME exchange are not required to apply INDS. Such companies shall continue to apply existing AS unless they choose otherwise. Once INDS are applicable, an entity shall be required to follow the INDS for all the subsequent financial statements, i.e. there is no looking back once the INDS are adopted by companies. Companies not covered by the above roadmap shall continue to apply accounting standards notified in Companies, Accounting Standards, Rules, 2006. For scheduled commercial banks, excluding RRBs, insurers/insurance companies and non-banking financial companies, NBFCs, non-banking financial companies, NBFCs, Phase I, from April 1, 2018, with comparatives. NBFCs, whether listed or unlisted, having net worth INR 500 crores or more holding, subsidiary, JV and associate companies of above NBFC other than those already covered under corporate roadmap shall also apply from said date. Copyright the Institute of Chartered Accountants of India. 1.24 Phase 2, Accounting from April 1, 2019, with comparatives. NBFCs whose equity and/or debt securities are listed or are in the process of listing on any stock exchange in India or outside India and having net worth less than INR 500 crores. NBFCs that are unlisted having net worth INR 250 crores or more but less than INR 500 crores holding, subsidiary, JV and associate companies of above. Companies other than those already covered under corporate roadmap shall also apply IND. As from the said date. Applicable to both consolidated and individual financial statements. NBFC having net worth below INR 250 crores and not covered under the above provisions shall continue to apply as specified in Annex II to Companies, Accounting Standards, Rules, 2006. Adoption of INDS is allowed only when required as per the roadmap. Voluntary adoption of INDS is not allowed. Scheduled commercial banks, excluding RRBs, scheduled commercial banks, SCBs, excluding regional rural banks, RRBs, were initially required to implement INDS from April 1, 2018. However, RBI, Reserve Bank of India, via press release dated April 5, 2018, deferred the implementation of INDS by 1 year, i.e. to be effective from April 1, 2019 instead of April 1, 2018. Further, the RBI through a notification dated March 22, 2019, deferred the INDS implementation till further notice. This was because the amendments recommended by the RBI are still under consideration of the Government of India. Therefore, RBI took a decision to defer the applicability of INDS till further notice. Urban cooperative banks, UCBs, and regional rural banks, RRBs, are not required to apply INDS. Insurers/insurance companies. MCA had outlined the roadmap for implementation of INDS by insurers/insurance companies from April 1, 2018. Copyright the Institute of Chartered Accountants of India. Introduction to Accounting Standards. 1.25 IRDAI, Insurance Regulatory and Development Authority of India, deferred the implementation of INDS in the insurance sector in India for a period of 2 years, whereby the effective date was deferred to April 1, 2020. However, insurance companies were required to submit pro forma IND financial statements to IRDAI on a quarterly basis effective December 31, 2016, vide circular dated June 28, 2017. Further, IRDAI in its meeting held on December 20, 2019 decided to implement IND 109, financial instruments and IND 117 simultaneously, along with other applicable INDs. In India, IND 117, converged with IFRS 17, is still at an exposure draft stage and will be updated based on the amendments made to IFRS 17. Once IND 117 is notified in India by MCA, IRDAI would be in a position to notify the regulation on preparation of IND compliant financial statements and modify other regulations that may be impacted due to the implementation of IND 117. Therefore, the effective date of implementation of IND for insurance companies is not yet finalized, and it would be finalized after the finalization of IFRS 17 by IASB. IRDAI, vide circular dated January 21, 2020, has deferred implementation of INDs in the insurance sector till further notice. The circular dated June 28, 2017 was also withdrawn by IRDAI along with the requirement of pro forma IND financial statements being submitted on a quarterly basis as directed in that circular. Summary: the accounting standards aim at improving the quality of financial reporting by promoting comparability, consistency, and transparency, in the interests of users of financial statements. The ICAI has, so far, issued 29 S. However, S6 on depreciation accounting was withdrawn on revision of S10 property, plant, and equipment, and S8 on accounting for research and development has been withdrawn consequent to the issuance of S26 on intangible assets. Thus, there are 27 S at present. In the scenario of globalization, India cannot isolate itself from the developments taking place worldwide. In India, so far as the ICAI and the government authorities and various regulators such as SEBI and RBI are concerned, the aim has always copyright the Institute of Chartered Accountants of India 1.26 accounting been to comply with the IFRS to the extent possible with the objective of formulating sound financial reporting standards. INDs are IFRS converged standards issued by the central government of India under the supervision and control of ASB of ICAI and in consultation with NFRA. As per the MCA notification dated 16th February 2015, INDs converged with IFRS shall be implemented on voluntary basis from April 1, 2015 and mandatorily from April 1, 2016. Separate roadmaps have been prescribed for implementation of INDs in banking companies, insurance companies, and NBFCs. Test your NOLDGA MCQs 1.